Hello, my name is Joe Hoyle, speaking to you from the University of Richmond, and I'm here to introduce Chapter 14 to you in our financial accounting textbook. This is a very interesting chapter with a lot of information about bonds, notes, and other non-current liabilities. I want you to get off to a good start so that when you read this chapter, you will understand all of the information that is provided. In the previous chapter, we looked at contingencies and current liabilities, such as gift cards, warranties. Here in Chapter 14, we move to non-current liabilities, bonds payable, notes payable. Companies that are going to grow need to get money. You can get that money from the stockholders, and you certainly get some that way. You can get the money from profitable operations, and again, you certainly get some of it that way. But almost any company that's going to operate and grow will need some amount of debt financing, money that comes from borrowing. That's what this chapter is about. Borrowing money so that you can build warehouses, that you can buy equipment, that you can grow your company. Now, you might begin by asking, why do you choose debt financing? There are a lot of people that argue and talk about the merits and the problems with debt financing. Debt financing allows you financial leverage, which means that you're using someone else's money to make a profit. And as long as you can make more profit than the cost of that financing, you can make profit without putting up any of your own money. And business people always like to make money off of other people's money. In addition, the interest expense that you pay on debt financing is tax deductible. So if you pay interest of 6%, then the tax deduction will reduce the cost to you. It doesn't really cost you 6%. On the other hand, as you might imagine, debt financing is risky. You have to make those payments. You're required to make those payments. If you do not pay when due, you can be forced into bankruptcy. So although debt financing has many advantages, it certainly does have risk. So you need to make decisions about whether you choose to have a lot of debt financing, and some companies do, or only a little bit of debt financing. In this chapter, we discuss notes and bonds. In my view, a note is something that you negotiate with another party. So, for example, if you want to buy a house and you go to the bank and you sign a debt agreement, that typically is called a note. You have negotiated that amount with the bank directly. A bond is a debt that you sell to the public. Many companies raise lots of money by issuing bonds. They come up with $1 million, $10 million, $100 million worth of bonds. They go out into the market and they sell those bonds. It is the selling of those bonds that raises lots of money for organizations, especially very large organizations, to grow. Whenever you have a note or a bond, it's very important to know the terms. If you look at the contract, which we often call an indenture, it will tell you when the principal amount is due, when the interest payments are due, the amount of the interest. It will tell you the type of security and any covenants on that debt. All of those are very important to understand the obligations you have when you borrow money. Here, we're going to look at 3 types of bonds. We're going to begin this coverage with zero coupon bonds, and then we'll look briefly at term bonds and serial bonds. The difference in zero coupon bonds, term bonds, and serial bonds is in how the payments are made. Let's start with a zero coupon bond. A zero coupon bond promises a single payment at the end of the term. And there is no cash interest paid. That's why it's called a zero coupon bond. There is no cash interest paid. Immediately, you should ask yourself, why would anyone buy a bond that doesn't pay interest? Zero coupon bonds are sold at a reduced price. They're sold at a discount. So the way the interest is conveyed is that you pay, let's assume, $800, and then a couple of years later I pay you back $1,000. Therefore, the difference in what you pay me and that I eventually repay you is the interest. So a zero coupon bond of $10,000 would be sold at a discount to provide interest. Now immediately the question comes up, how do you determine the amount to pay? In the business world, that's a very important decision. If you're going to buy a bond, especially a zero coupon bond, how much are you going to pay? Well, there's where the term present value comes in. And you will find, if you study accounting for long, that present value is a very important concept. Now let me explain before I talk about the zero coupon bond what present value really means. You take all of the future cash flows that the contract promises. I always tell my students here at the university, start with knowing exactly what the future cash flows are going to be. Whether they come from interest or principal or whatever, what do you have to pay? Then you determine the real amount of interest. And when you do that through the present value computation. And you pull that interest out. So if you take all of the future cash flows and you remove a reasonable amount of interest, what you have left is the present value. The value of those cash flows today. The value of those cash flows without any interest at all. Now, how do you determine a reasonable amount of interest? When you sell a zero coupon bond, that is negotiated between the buyer and the seller. I might offer you 4% interest and you might want 7% interest, and we might negotiate and we might discuss and we might finally agree on 5%. It's a negotiated rate between the buyer and the seller. What else do you need to know to determine present value? You need to know that negotiated rate. You also need to know the number of time periods. So for example, if it's a 2-year bond, there are 2 time periods. And finally, you need to know the pattern of the cash payments. Some cash payments are considered to be a single amount. You pay $10,000 in 5 years. That's a single amount. An annuity is equal payments made at equal time intervals. So if you pay $1,000 each month, that's an annuity. Equal payments at equal time intervals. If you pay $3,000 every year, that's an annuity. Equal payments at equal time intervals. So what are the 3 things you need to know to determine the present value? In other words, to pull out a reasonable interest. You need to know what that reasonable interest is. And with bonds, it's often the negotiated rate between buyer and seller. We sometimes refer to that as the yield rate. We sometimes refer to that as the effective rate. In addition, you need to know the number of time periods and the pattern of the cash flows. Now, once you know those 3 variables, how do you determine present value? There are many ways to determine present value. You can use a table. The table will tell you what the present value figure is. You can use an Excel spreadsheet. You can make a mathematical computation. All of these are discussed and demonstrated in the textbook. Now the next thing we need to know is, how do we recognize that interest? How do we recognize the interest of $5,000? The preferred approach is called the effective rate method. So let me give you a simple demonstration of the effective rate method. Let's assume that you do buy this bond for $15,000 because we negotiated a 10% rate of return. Then at the end of the year, we would compute the interest as $15,000 times 10%. That's $1,500. What do we do with the $1,500? Well, know that because it's a zero coupon bond, we are not going to pay it until we pay the $20,000 at the end. Anytime that you compute and recognize interest and you do not pay it, then you add it to the principal. That's called compounding. Recognize interest but do not pay it. That's called compounding. So at the end of that year, the bond is no longer reported at $15,000. It's now reported at $16,500, which is the original $15,000 plus the compound interest of $1,500. If you do that for the entire term of the zero coupon bond, it will arrive back at $20,000. Now, there are two other types of bonds that we want to mention briefly. A term bond does pay interest each term. So I might offer you a $20,000 term bond that pays 8% interest each year. 8% of $20,000 is $1,600. So I pay $1,600, $1,600, $1,600, and then eventually, at the end of the term, I pay $20,000. What has changed here are the cash flows. If you and I negotiate a 10% rate, if you want 10% and I'm willing to give you 10%, then we take those cash flows and we find the present value based on a 10% rate. And again, what that does is it pulls an interest out at a 10% rate, and what you have left is the present value. So for example, a $20,000 8% bond that is sold to yield 10% might sell for $18,200. If you pay me $18,200 now, and I pay you $1,600, $1,600 for whatever length of time, plus $20,000, we can assume that's a 10% rate of return, which is what we negotiated. When you recognize interest on a term bond, it is slightly different than when you do it for a zero coupon bond. You determine the interest for the first period, but instead of compounding the entire amount, you only compound the amount above what you paid. So for example, if I sell you this bond at $18,200 to yield 10%, then the amount of interest would be $1,820. That's 10% of $18,200. I'm only going to pay you, though, on an annual basis, 8%. That's $1,600. So how do you recognize the additional $220, the amount of the $1,820 over the $1,600? That's the compound part. You only add to the principal the amount over and above what you pay in interest. And finally, this chapter talks about serial bonds. In a serial bond, we do pay interest each period. But in addition, we also pay part of the principal each period. We don't wait until the end of the term to pay the principal. We do that all along. If you buy a house, for example, that's a serial debt, because every month when you make your house payment, you're paying both interest and part of the principal as you go along. Those of you who are interested in finance for a career should find this chapter especially interesting. When you're talking about how companies finance their operations and their expansion, you have a world of ideas and a world of things you can do. Whether you use zero coupon bonds, term bonds, serial bonds, or other types of debt. These are things that companies must do in order to grow. And of course, financial accounting must be able to report this in an understandable fashion. Read the chapter, learn about present value, learn about these bonds, and I think you'll start seeing how the bond market and how company growth takes place. Have fun.